Good evening, everyone. We're going to get started with our webinar. This is Kathy Mealy. I'm one of the financial advisors with Sensible Money. And Dana, if you can just switch the slide, we can look at the map. I still haven't moved. I'm still on the East Coast in Marblehead, Mass. And as you can see, most of our staff is in Scottsdale, Arizona, where our main office is. We also have a financial advisor over in California. And then Jody is also up in the southwest portion. We have advisors all over because we work with clients all over the United States. And it's just as you're watching this webinar with today's technology, this is what allows us to work with clients. Dana is going to be presenting our webinar tonight, How to Invest for Retirement. And Dana is the founder of Sensible Money. She is also About.com's Money Over 55 expert since 2008, and she also is coming out with the second edition of her book, Control Your Retirement Destiny, which should be out in the next 2 months. So Dana, with that, I am going to turn it over to you so we can begin our presentation.
Great. Thank you, Kathy. Well, I want to thank you all for taking your time out of an evening and spending it with us. We're going to provide a lot of valuable information on planning for retirement and specifically how you begin to structure your investments for that phase in your life. I want to start with looking at why is it so important? Well, you don't want this to be you. You don't want your 80-year-old you to be going door to door. It's really important to get what we call the decumulation side of retirement planning right. And you don't get a chance to do it over. When you're in your 30s and 40s and still contributing money to savings, there's a lot of wiggle room for mistakes. But once you're retired, that plan needs to work and you need to know you've got it right. So that's what we're going to be talking about tonight. We're going to start by taking a look at the perfect investment. This is what everyone wants. It would be completely safe. You wouldn't have to worry about your principal going down. It would provide enough growth that you could have income that would keep pace with inflation for the rest of your life. And the income portion would be very consistent. You wouldn't have to worry that your dividends would go down. It would just come in like your paycheck does very regularly. Well, unfortunately, this investment doesn't exist. Yet all the time we see people who are looking for this. And by looking too hard, that's how sometimes people get themselves into serious trouble. They jump into an investment that looks so good to be true because it was marketed as if it delivered all of these things. In reality, it's about trade-offs. And this process of creating a portfolio is figuring out how much do you need to allocate to each corner of this triangle. And there's some really smart ways to do that when you're headed into your retirement years. So what we're going to do is we're going to take a look first at each corner of this triangle and which investments fall into this category. And then we're going to look at how you're going to put them all together. So we're going to start with the safety corner of the triangle. Now, the great thing about safe investments is if you walk into the bank and you have $1,000 there, you don't have to worry that next week you're going to go into the bank and they're going to say, sorry, your $1,000 is only worth $800 today. Your principal is what's safe. But as far as the interest portion, that can fluctuate. And right now, interest rates on safe money are nearly zero. We call that the price of safety. And it's one of the biggest questions that we get is, I need to put my cash reserve somewhere. I need money that I'm going to be using to buy a new house in 6 months or a year. Where can I put it? Well, if it's safe money, you're not going to earn a whole lot. And as soon as you move that money into something that's going to earn a slightly higher yield, you're going to be taking some risks that the principal will not stay stable like you see this line here. Now, I remember it was 2000, you could earn over 6.5% on money markets and liquid savings accounts. Unfortunately, that's not where we're at today. And the sooner we accept that reality and plan for it, the more stable and secure our retirement plans will be. As a matter of fact, if we go back to 1993, here's a quick snapshot of where CD interest rates have been. We saw them dip down in 2003 and then back up. And unfortunately, right now, here's where we are. So let's move on to the income corner of the triangle. It works a little differently. With income investments, the interest line or the income you receive is what stays stable, but the principal can still fluctuate. Let me give you an example. Let's say I'm selling bonds in Dana Corporation. Now, all a bond is a loan. So if you buy a bond, you are making a loan to the entity that issued it. That could be a city or a state in the case of municipal bonds. It could be the government in the case of treasuries or agency bonds. It could be a corporation. So let's say I've got Dana Corporation and I'm issuing a $1,000 bond, and my bond is paying a 6% interest rate. You're going to get $60 a year every single year, and let's assume it's a 10-year bond. At maturity, 10 years from now, you'll get your $1,000 back, assuming I stay in business and I am of good credit quality. But what's going to happen to your principal along the way? Let's say interest rates suddenly go up from 6 to 8%, and you've owned that bond for a few years. Investors are going to look at you and say, well, you know what? Your bond is only paying 6%, but the current rate is 8%. And so we're not going to give you that full $1,000 back if you want to sell your bond today. Maybe we'll give you $800 for it. So the principal with bonds can fluctuate, and where that's of concern is if you sell the bond before it matures. If you're planning on holding the bond to maturity, those principal fluctuations aren't really relevant to you. And that's why you'll see in the news today a lot of controversy. Some people say, don't buy bonds, interest rates are so low. Well, what they're worried about is that when interest rates rise, those bond values will go down. But if you've bought the bond for a specific purpose, to own it to maturity, those fluctuations aren't going to matter to you. Specifically, if interest rates rise, what is the amount of principal that you could expect to see go down? Well, here you can see if rates rise by 1% and you had a bond that had 5 years left to maturity, you would expect the principal value to go down by about 4.5%. Now, again, if you bought the bond and you plan on holding it to maturity, you're going to see that decline on paper, on your statement. You're not actually going to realize the loss because you're going to hold the bond to maturity. And that's one distinction we like to make really clear when it comes to the income corner of the triangle. And then let's take a quick look at the growth corner of the triangle. Growth are things that we expect are going to appreciate over time, real estate and stocks primarily. Now, when we talk about the stock market, you'll hear this term called capitalization or market cap. What does that mean? Well, you take the number of shares outstanding times the current price per share. So, for example, if you had a company that had 4 million shares and a price of $25 a share, it has a market cap of 100 million. If it had 40 million shares at $25 a share, the market cap would be $1 billion. Now, $1 billion probably sounds like a lot, yet the average small cap company today, what are considered small companies in the stock market, are worth $1 billion. Mid-cap companies typically fall in the $5 to $10 billion worth, and the average large-cap company over $100 billion. Now, when you start to put this together and you look at how mutual funds work, this would be a sample of a large-cap mutual fund. The mutual fund buys a whole set of stocks that fit the definition of large cap. It depends on the goal or objective of the fund. And mutual funds have an expense ratio. Actively managed funds try to pick which stocks are going to do the best. They might interview managers and customers and study financial statements. And passively managed funds, what are called index funds, simply say, you know what, we're not going to do all of that extra research. We're simply going to own all the stocks that fit the definition of large cap. Passive funds and index funds have much lower expense ratios. And even Morningstar's own research shows that buying low expense funds is one of the best ways to get better performance out of your funds. Think of it like this. An actively managed fund has to overcome all of the extra costs that they have to pay for analysts to do all of that research. A passive fund doesn't have those extra costs, and so that savings comes back to you in the form of returns. Now, when we dive a little deeper into the growth corner of the triangle, here, this this is what's called, first of all, a Morningstar style box. So Morningstar will break all of the world of publicly traded stocks, and this is just the U.S. market here, into horizontal categories, large cap, and then the middle line is mid cap, and then this bottom line is small cap. And then the vertical categories, what are called value stocks on the left, growth stocks on the right, and then in the middle are core. Now, value to growth is determined by certain characteristics that they see on the financial statements, things like price to earnings ratios or price to books ratios. But large cap, mid cap, and small cap are determined by the value of the company. About 70% of the U.S. market falls in this large cap category. About 20% falls in this mid-cap category, 20 to 30% actually, and then this last remaining bit, small cap, ranges usually under 10% of the U.S. market. Here you're looking at the returns in 2013, and you can see all of the different categories are green. Yet even within the U.S. market, you saw small cap growth stocks up nearly 42%, whereas large cap value up about 29%. Now, I'd take any one of those boxes as far as my portfolio return for the year. So they all look great, yet there can be a broad difference. And when people talk about the market, they tend to lump all of this together. And so they might say, well, the market did X. When you start to look a little more deeply, you see that different sectors of the market can perform very differently. Here was 2008. Not a good year for any of these sectors. And yet again, you see a difference in how they performed. In 2008, it was large cap growth that did the worst, and small cap, actually, yeah, definitely the worst, and small cap value that did the best. And then we have a year with mixed results. So here was 2001. And in 2001, you can see that growth stocks didn't do so well, but small and mid-cap value stocks did. There can be many years like what you're seeing in 2001, and that's the point of having a diversified portfolio. A lot of people end up having choices in their 401k plan, and the most common way that people pick investments is they simply look at the 5-year returns, or they look at what did the best last year. Well, unfortunately, that can lead you to own all of the same type of mutual fund, perhaps all large cap. That's actually something we see on a fairly regular basis. Now, that's great if that was last year, but it's like driving, looking in the rearview mirror. That is not the way to build a portfolio. You want to own a little bit of each category so that your portfolio can weather all different types of markets. And when it comes to bear markets, that's defined as a point in time where the market is down 20% or more from its previous high. And that's what we're all really afraid of. That's what happened in 2008. Well, here, these are the calendar years in the past that this has happened. So we have 1930, 31, 37, 74, 2002, and 2008. When we look at in total, the years that the U.S. stock market, and here we're just looking at the S&P 500, which falls in that large cap category. So we're not looking at small cap or mid cap on this chart, just U.S. large cap. Negative returns 27% of the time, positive returns 73% of the time. Now, I don't know about you because I'm not a gambler, but I would go to Vegas on these odds. The problem is people don't look at the market that way. They invest in a good year, and then when a bad year comes along, they often bail out, and then they miss the subsequent good years. And so the way to invest in the market is to look at it as a whole, to play the odds, to say, okay, the portion of my money that's going to be in the growth corner of the triangle, it needs to be long-term money. I need to plan on leaving that money alone for many years. I'm not going to try to time and move it in and out of the market. And it needs to be broadly diversified across both small cap, mid cap, international, all different types of asset classes. There's another way of looking at market performance. This is called the growth of a dollar chart. And in this chart, we're going back to 1926, and it has not only large cap stocks, which is this darker orange line, but it also has small cap. And then it has long-term government bonds, treasury bills, and inflation. So the inflation line is telling us that at the end of 2015, it took $13 to buy what you could buy for $1 back in 1926. With long-term government bonds, what you're seeing is that if you had invested $1 in 1926, then it would be worth $135 today. And then you can see what it would be worth if you had invested it in large cap stocks and small cap stocks. Now, I often call this one of the most misleading graphs used in our industry. So what looks great on this graph? I'm going to have you go ahead and just type in an answer. No right or wrong answers. Just tell me, what do you see? What looks great on this graph? All right, I'm starting to see some answers come in. Keep going. Awesome. Yes. I'm not going to give it away yet. I love this answer, upward trends. Yes, all of the upward trends look great. I do agree with that. So I'm seeing a lot of answers that say small cap stocks and some answers that just say stocks. So yes, I agree. They're all correct answers. What looks the best is small cap, and in general, stocks look fantastic. But what happens when we zoom in and look at some of the underlying decades? This was 1969 to 1978. Here, small cap stocks, this lighter orange line, at one point were worth about 50 cents on the dollar before they recovered and finished the decade at about the same value that they had started the decade at. And you see the S&P 500 large cap stocks, this darker orange, averaged 3.2%, long-term government bonds, and then we had inflation. So during that particular 10-year time period, it really didn't matter what you do, you lost purchasing power to inflation. Then we had the decade of tech stocks. This was when everyone thought they would be rich, and I remember running financial plans in the 90s, and it was common to use 10, 12% rates of return and have clients come back and say, well, I think that's too low. I think you should project a 14% rate of return. Well, the reason people were thinking that, look at the S&P. During that decade, it averaged 19% a year. Small cap stocks averaged 15%. Even long-term government bonds did great, and inflation stayed tame. Technology stocks in the late 90s soared, and I remember one client wanting to move all of their money into a science and tech fund. I actually had him sign a disclaimer that I advised against it. And unfortunately, right after 1999, tech stocks took a dive and didn't recover nearly to the degree the diversified portfolio would. That's the danger in chasing trends. Some people look at this decade, and sometimes I still think that we're all suffering a little bit from post-traumatic stress disorder and resetting expectations because these returns didn't materialize. Instead, what we got was what the media has sometimes deemed the lost decade. This was from 2000 to 2010. And although the media referred to it as a lost decade, it wasn't entirely lost. Look at small cap stocks. They averaged 10.3% over that 10 years. And actually, if you'd had a diversified portfolio and just stuck with it and included international asset classes and emerging markets, you would have averaged somewhere between a 7 and an 8% rate of return over this decade. So it certainly wasn't lost. But it didn't meet the expectations that were set in the 90s. The challenge is when you apply this to your retirement years, you don't know what kind of decade you're going to get. You don't know what your first 10 years of retirement is going to look like. If it looks like the 90s, you'll be set. But if it looks like one of these other decades, you'll need to plan a little more conservatively. Another way of looking at this data is in terms of rolling returns. So let me explain what a rolling return is. When you see mutual fund returns that are published, they are typically published in terms of calendar year returns. So 1 year, 2015, 2014. A rolling return says, I'm not going to look at just calendar years because most investors don't put their money in January 1st and take it out December 31st. Instead, we're going to look at every 12-month period. So January to December, and then 12 months starting in February, and then the next 12 months starting in March. And so here we can see when we look at one-year rolling returns, if you were to set expectations for the growth corner of the triangle, that's these red colors. This is large cap stocks, the S&P 500, and then the slightly lighter red are Russell 2000, which are small cap stocks. In any 12-month period, you could expect that that portion of your portfolio could be up as much as 60%. Actually, sorry, they're backwards. This darker red are small cap stocks, and the lighter red are large cap. So in small cap stocks, this portion of your portfolio could be up almost 100% in a single 12-month period, but it also could be down as much as 40. Then you have the S&P up as much as 60, down as much as 40. In long-term government bonds, you see a narrower range of outcomes. Then as we move into safer choices, these green and blue colors typically represent the income category, and this light green really represents the safety category. Here in the safety category, you never had a one-year period where you lost money, but your upside potential was also limited. How does this look, though, when we start to look at longer time periods? Here's what it looks like over 20 years. Now we see there was no 20-year period where you would have had losses. Small cap stocks, this darker red, you could have had a 20-year period of time where your returns were in excess of 14% a year. Your worst 20 years, they still averaged over 6% a year. Same with large cap. Then we move into government bonds, corporate bonds, more government bonds, and treasury bills. So what you see here is if you had all your money in the safety corner of the triangle, if your retirement could sustain, could sustain yourself on a rate of return somewhere between 4 and about 7%, that probably would work. However, if you want the potential for higher returns, you have to venture into riskier asset classes. Now, when we talk about risk, some people talk about the stock market as if it was a certain thing. But you can see that there are certainly time periods where the stock market did okay, but it didn't do all that much better than safer choices would have done. And that's why we say if it were a certain thing, there would be no such thing as safe investments. You wouldn't need safe investments. What you have to be prepared for with your growth corner of the triangle is volatility. And as we said, you have to be willing to stick it out for the long run. And when we look at this data, what we like to do is build our retirement projections on these worst case returns. So we use a 5% annual average return in our projections. Some people think that's too low. It's not our expected return, but I want to know that the clients we work with are going to be just fine if we get the worst 1/3 of market conditions. I don't want to base their plan on them achieving these returns. The market may not deliver that. And you can build the perfect portfolio, but if you get the 20 years in history that delivers this, that's what you're going to get. So what about real estate? I think real estate can be a great investment, but you have to know what you're doing. Think about an area like Detroit. You could have owned a lot of rental properties there, and the auto industry goes through a horrible time period. People move out, and all your properties are now sitting empty, not having any income coming in for you. So there are risks to real estate. The biggest mistake I see people make with real estate is they read a book or two on real estate investing or attend a seminar and jump right in thinking this is going to sustain them in retirement. It is a profession, and it needs to be treated with the respect that a profession deserves. For those who have experience in real estate, I think it can be a great way to add to your retirement portfolio, but I don't like to see people, especially people without experience, base their entire retirement income on this asset class. Then we have gold. Gold, believe it or not, we don't really consider it an investment. It's really a speculative investment. It is a way to bet, and gold can be a good hedge in terms of a time of crisis. Many people think of it as an inflation hedge, but historically it actually has not been a great inflation hedge. Real estate and stocks have been a better inflation hedge than gold. The challenge with gold is it produces no income and it makes no goods or services. So unlike a company, it's not actually delivering value. And so you're really just betting on where the price of gold is going to go. We don't like gold necessarily as a substantial part of retirement portfolios for that reason. You can't count on it delivering results. Then there's one investment category that's not neatly covered with the investment triangle. It's really a hybrid. It would fall between the growth corner and the income corner. And that would be high yielding investments, things like closed-end funds, high dividend paying stocks. There's Canadian Energy Trust, Real Estate Investment Trust, Master Limited Partnerships, preferred stocks. These holdings often are not as tax efficient, depends on what type of account you own them in. The challenge for retirement is that the dividends can be cut. We saw that in 2008, 2009. Many companies eliminated dividends altogether or cut the dividends in half. Now, I don't want to be sitting there with a retiree and going through a time period where dividends are slashed saying, you know what, I'm really sorry, but you have to cut your retirement, your standard of living in half this year because all of the dividends just got cut in half. So as far as its reliability factor, it's not the vehicle we like to use to build retirement portfolios for exactly that reason. Now, that being said, if I were to look at the results over a 20 or 30-year period of time, I think as far as returns go, you could probably do just fine with a high-yielding investment portfolio composed of these types of things. But it's the reliability factor of needing to spend that income, of needing to consume it, that we're looking at. And that's what we're concerned with these types of investments. That concern has to do with a shift in goals. In retirement, you are no longer solving for maximizing return for a given level of risk. So what do I mean by that? Well, we're going to look at it in a few slides, but typically portfolios are constructed around risk as measured over 1 year. In retirement, you have a 20 or 30-year time horizon. There's a portion of your money you're going to need in 1 year, but there's a portion of it that's invested for 10, 15, 20 years down the road. Making that distinction is important. What you're solving for in retirement is how do you ensure a minimum level of consumption? You need paychecks, and you need them to come in every single month, just like it worked when you were working. One of the risks that affects the ability for these paychecks to come in is something called sequence risk. Let me explain how it works. Let's say you start with $500,000, and we have accumulator A and accumulator B. Just ignore the right side of the slide right now. In both scenarios, well, in this scenario, the market for accumulator A goes up 20%, and the market for accumulator B goes down 20%. So at the end of the year, the accumulator now has either 600,000 or in the down market, 400. The following year, the market recovers back up 20%, and the returns happen in exactly the opposite order. So accumulator A, market goes down 20%. Both people end with the exact same amount. The volatility in the market had no impact on them. They weren't adding money, they weren't taking money out, so it had no impact on them. But now let's look at these same market conditions with a decumulator, someone who's withdrawing. Same scenario, start with $500,000, market either goes up 20 or down 20 the first year. Market goes up, this person needs $50,000 to take out. So they take $50,000 out and they have $550 left. This person needs $50,000 also, but their portfolio went down. After they take 50 out, they have $350 left. Now that recovery happens, and there's a differing amount that they're left with. In the strong market, this person has $440 left over, but the person who had the bad sequence of returns right off the bat only has $420. Now, this is one of the problems with using average returns in retirement projections, that it doesn't factor in how the down markets affect you when you're taking money out. For example, this is a lump sum investment, same kind of scenario, but now we're looking at real returns. This is the S&P from 1973 to 1982. Here we can see there were some down years right off the bat and some really strong years, another negative year, and some more strong years. Well, if you had projected in your software or Excel spreadsheet or online calculator that your funds were going to average 6.7% a year, which is exactly what the S&P averaged over these 10 years, here's what your software would show. Like a staircase, nice, neat, account value goes up each and every year. Here's what actually happened. Account value would have gone down, then up, down, up. That's volatility. But in the accumulation phase, you ended up with the same amount. This is what we call the investment return. The mutual fund did well over that time period. But if you were decumulating, if you were withdrawing money, what happened? Now there's the exact same scenario, but you're taking out $6,000 a year. Well, as an investor, if you had projected this in your financial planning software at 6.7%, you did okay. You still had this just over the amount of principal you started with while withdrawing money the whole time. That's if you average 6.7% a year. But that's not what happened. Because of the volatility, at the end of the 10 years, what you actually have is $83,000, not $109,000. So this is what we call sequence risk, but it's also a planning risk. When people run their projections, if they're not accounting for volatility in some way, their plans may overestimate what could happen if they encounter a series of bad years, particularly if those years occur early on in retirement. The actual rate of return for this decumulator was 4.64%, not the 6.7%. So if you were to look at the mutual fund with a published return of 6.7, that is in fact what the mutual fund earned. But what's called your internal rate of return, your investor return, would have been 4.64 if you were withdrawing funds over this time period. When we look at how traditional portfolios are constructed, they're along the lines of something called the efficient frontier. The efficient frontier has return on the vertical axis, risk on the horizontal axis. And what you see is that there's a point as you start adding stocks to the portfolio that the potential for return goes up, but the risk goes up also. And risk is measured as volatility. What are those the degree of ups and downs that we can experience? Well, when you're younger, what you want is the potential for the highest return possible. So you steer your portfolio toward the 80% stocks, or I'm at nearly 100% stocks. I'm not going to touch that money for at least 20 years. I want to give my portfolio the maximum potential for return, and I could care less about risk or volatility as measured over 1 year, 5 years, or even as measured over 10 years. But in retirement, it's a little different. So here's what the efficient frontier looks like for retirement. Let's assume on the left, on the vertical axis, you have your remaining portfolio value. And then on the horizontal axis, you have the annual amount you want to consume. So if you have about $2 million and you want to consume about $10,000 a year, that's obviously a very safe portfolio. But as you want to start consuming more, you can see that you need to expect that you're going to spend your principal down faster. So if we were to design a portfolio on this frontier, if we wanted a maximum income portfolio, it would look very different than a portfolio where your goal was to preserve principal that was either going to pass on to heirs or preserve enough that if you were to live to a very long age, you would still be okay. This is actually a different math problem that we're solving for in retirement than we are during our accumulation years. And it calls for a different way of investing, a way of investing that takes into account these contrasting objectives here of maximizing consumption versus maximizing remaining assets left over each year at the end of the plan. So let's take a look at how all this plays out in real life. This is an actual client, had been my client since 2004, not yet retired. So when we look at market volatility, 2008, 2009, that's what you're seeing right here in this dip. So this orange line is the net amount of money that this person put into their account. The blue line is their total portfolio value. They're in their accumulation years, so they're steadily adding funds. And we can see that, yeah, this was a scary time period, but in hindsight, it really had no impact on them achieving their goals. But what about somebody who's in the decumulation phase? Here, we're seeing someone who retired, and they actually didn't retire till right about the worst possible time you could retire, the end of 2007. The reason I know that is this orange line is going down. It's going down because they are taking withdrawals. So the net amount of money that they've put into the account is slowly going down. The blue line again represents their portfolio value. What happened here? This person was involved in a lawsuit, someone that owed them money, and that they finally won, and that person paid them back. And so they had a large addition to the portfolio. Well, what you're seeing is she was withdrawing about $5,000 a month. And despite the portfolio value going down to about $650,000, $700,000 in 2008, 2009, over the long run, things worked out just fine. The portfolio recovered, and more importantly, this retiree was able to maintain their standard of living. We were solving for consumption, and they were able to maintain the level of consumption that they wanted despite poor market conditions. The key in putting all this together is really understanding what you can control and what you can't. So we can't control market conditions. We can't control inflation. We don't know what the economy is going to do, and we certainly don't know how long we're going to live. It would be a lot easier if we knew that exactly. What we can do is learn how to adjust the things on the left side of this drawing. We can work a little longer if we need to. We can control the amount of investment risk that we take. We can manage taxes. We can manage our spending. And all of those things are a way of monitoring as you go along. As you're making small adjustments to your portfolio, you can make sure that your portfolio absolutely will last as long as you need it to, but it's not a set it and forget it kind of strategy. So as we look at focusing on these things and how you put all of the investments at the various corners of the triangle together, I'm going to talk about 4 strategies you can use. 1, total return. With a total return portfolio, you are setting an allocation, such as 60% stocks, 40% bonds. And then you're taking systematic withdrawals. You're selling equal portions of each asset class as you draw down. So essentially, every year you're rebalancing. With the income-only approach, you're buying high-yielding, dividend-paying investments, and you're only spending the dividend and interest income that they generate. That works great if your primary goal is to preserve principal to pass along. But as we discussed, you have to be prepared for years where dividends will get cut and your income may go down. There's the guaranteed income approach. This is where you buy annuities, particularly immediate annuities. Now, if your goal were absolutely to maximize the amount of income that you can take and you're not concerned about leaving principal, immediate annuities are one of the most effective ways to do that. So if we were to look at that efficient frontier and you wanted maximum income, this would be something to consider. And then there's an approach that we prefer, what's called asset liability. Asset liability matching really has to do with lining the investments up with the point in time where you're going to need to use them. So we can create a schedule where we know exactly how much you're going to need to withdraw from which account. And we can buy bonds that are going to mature to meet those withdrawals for the next 5 to 10 years. And as we discussed, we know what we're going to get and when we're going to get it when we buy a bond and we hold it to maturity. And then our growth investments can be used for the longer term where we're giving ourselves the highest probability for additional returns. So let's take a look at some of these options in a little more detail. If you want to use a total return approach, you have to use a multi-asset class portfolio. You want no more than 80% stocks and no less than 50%. And what you're doing is targeting a rate of return of around 6 to 7% and planning on withdrawing about 4% a year. Your portfolio should own all of the asset classes you're seeing here on the right. And there's a set of rules, monitoring rules you can use that can help make sure you don't run out. So we're going to talk about 2 of the rules. One of them is called the withdrawal rule. Let's say you start with $100,000 and you're withdrawing $6,000 or a 6% withdrawal rate. You want to measure this each year. So each year you take the total amount you withdrew divided by your starting portfolio value. And that's how you come up with your withdrawal rate. Well, let's say your first year of retirement, the market goes down. And so now your portfolio is $84,000, but you're still taking out $6,000 a year. So your withdrawal rate for that year was 7.1%. It was an 18% increase in withdrawal rate. So essentially, you get no raise that year. You have to maintain the $6,000 withdrawal. Let's say next year, the market goes down again. Now you have 67,000, you're still taking out 6,000 a year. Well, the withdrawal rule says, you know what, at this point, your increase in withdrawal rate, it's 50% higher than what you started with. And so you have to take a pay cut. You hit the capital preservation rule over here. And so you're going to take a 10% pay cut. Your income is going to go from 6,000 to 5,400. So these set of rules, basically by following the rules, you can say, well, if my withdrawal rate is going down, my principal's gone up, and so proportionately I'm not taking out as much as I was the year before, then you can give yourself a raise. You can use the consumer price index to determine how and when that's going to happen. But in bad years, you have to realize that you need to be able to forego that raise by leaving your withdrawal the same, or in a worst case scenario, you have to be prepared to take a pay cut. Now, those small changes by monitoring this way are what can keep your portfolio from ever running out of money. Then we have the income-only approach, and really we've talked about this. If you're going to rely on the dividends and interest income right now, unfortunately you're not going to get much. It's going to be hard to rely on that. But if you're going to rely on dividends and high-yield investments, keep in mind that at the time where things go not the way you expected and dividends are cut, the principal value is also going to go down at that time. So if you did need capital, you would be forced to sell assets at almost a fire sale kind of situation. Then we have the guaranteed approach. This is an effective strategy for those who, as we said, want maximum income, or those that we consider to be constrained. What do we mean by constrained? Constrained means that you really don't have enough assets to safely support the amount of retirement income you want to take. It's another way of saying you need maximum income. So annuities can be a great solution. They guarantee a minimum amount of income, and you're never going to run out. For higher net worth clients that aren't constrained, the other place that we like to look at as annuities is when we project out how the amount of expenses you're going to have in retirement, and we look out at your age 70. We like to see at least 50% of your living expenses covered by guaranteed sources of income. That can be Social Security and pensions, and if total amount of Social Security and pensions is not going to cover at least 50% of your living expenses, then you might want to consider an annuity to add in some additional guaranteed income. Why? Well, cognitive decline is real. I'm sure, maybe some of you haven't had any experiences with older family members or friends, but sometimes our judgment changes, and I've seen it with my own clients. And having additional guaranteed income layered into your plan later on brings an entire new element of safety. It can protect a surviving spouse. It can protect you from a future you that may not be as savvy at making decisions as you are today. And then we have the asset-liability matching approach. Think of this in terms of buckets, and each bucket represents a time segment. So let's use an example of a $2 million portfolio and someone that needs to withdraw $100,000 a year. The amount they have to take out in the next 12 months is in cash. And then there are bonds maturing for the next 7 years, $100,000 each year. Then we have the growth portion of the portfolio. And we're only going to withdraw from this bucket when it overflows. So when the market has good years, we're going to think of literally as this bucket overflowing, and we're going to sell off the gains, and we're going to add on to our bond letter. So after year 1, we would have spent this $100,000 of cash. We would have had a bond mature, and when it matured, we'd put it in cash to spend. And then when our equity bucket overflowed, we would buy another bond for $100,000 that matured out here in year 9 because our first 8 years were covered. So that process of asset liability matching matches up the safe investments. Price of safety is low returns, but that's money you're going to spend in the next 12 months. And then your income investments, that's the money you're going to spend in years 2 to, in some cases, 10. and then the growth investment, which has a much longer time frame on it. What we like about this process is it fits in with what I call the two most important questions you can ask about your money. Question number one, can I lose any money? Well, if it's money you need to spend next year, you want the answer to be no. Matter of fact, when someone's shifting into retirement, we like to see that the answer to the first 5 to 10 years of withdrawals that they're going to need, we like the answer to this question to be no. Can I lose all my money? We want the answer to this question to be no. And that's one of the reasons why we shy away from individual stocks. Individual stocks can be great if you hit the right one, but they can also become worthless. And we don't want any part of your portfolio to sustain that level of risk, what I call a risk level 5. So when building a retirement portfolio using the asset liability approach, it's almost like a barbell strategy, where the money you're going to need to spend in years 1 through 10 has a risk level of 1, and index funds are used with a risk level of 4 for the growth portion. Now, here's the thing about index funds. Think about it. Can you lose all your money in an index fund? Now, theoretically, the answer is yes, right? All Fortune 500 companies in the U.S. could go out of business at once. But if that happens, we've got a lot bigger problems on our hand than what our portfolio is worth. So we've eliminated what I call this risk level 5, and instead, we know we have to be willing to put up with volatility, but by using this asset liability matching approach, we can pick and choose when we're going to harvest that growth portion of the portfolio. And we're only going to do it in the good years. In the bad years, we're just going to leave it alone. Now, for retirees, we can take a withdrawal pattern and we work with our partner firm, Asset-Dedication, to produce what's called a critical path. So this critical path are these dotted white lines you're seeing in the background. And it's not an expected path, but it's, if your plan were to follow along this path exactly, you essentially would die with $1 in the bank out here about 35 years in the future. Now, I call this a spaghetti chart. Each yellow line represents an actual historical path. So assume you retired in 1927. That was one yellow line. It's a 36-year time period. Assume you retired in 1928, then 1929. So each yellow line is a real path that your financial accounts would have taken. Now notice most of the paths end up here in the green, where you have far more principal than what you started with. These paths that end here in the red are assuming no adjustments were made. So you didn't reduce spending, you didn't forego your inflation raises, you just continued to increase your income at 3% a year. In reality, small adjustments such as those capital preservation rules that we discussed could keep even these yellow paths on track. Now, as you go into retirement, you're only going to get one path. We measure that as we go forward, and it becomes a way to make decisions. So if you're in the green, and if you're several years into retirement and you're deeply into the green, then we know there's some wiggle room there to spend a little more, do some gifting, or leave more to heirs, or take a trip that you've always wanted to take. If you're in the pink zone or the red zone, those are the years where we can forego inflation raises, or if we have 2 years in the red zone, maybe it's time to implement the capital preservation rule and say, you know what, we're going to have to spend a little bit less this year because that's what's going to help that portfolio get back on track and get back into the green zone. What we love about this process is it's measured against your goals. It's not measured against some arbitrary benchmark like the S&P 500, which has absolutely nothing to do with your goals. This is the way you want to measure in retirement, against your goals. You need to be able to have paychecks every single month, and you have to have a process that can help bring some reliability to that outcome. So when we look at all of this, why is it so hard as humans to invest in a disciplined fashion? Well, we're really not wired for it. We tend to follow our instincts, and unfortunately, our instincts, our fight or flight instinct response, causes us to be irrational when it comes to investment decisions. There's all kinds of mental errors that we make, and overconfidence is one we'll talk about in just a minute. But we want to make bets, and those are some areas where I see some of the biggest retirement mistakes occur, is people get into this strange mindset. I had one person once that wanted to put all their money in a single stock to try to make up for lost time. Not a good idea when you're getting near retirement, and not a good idea ever if it's 100% of your money. What you really have to do is make a shift. So you're shifting away from emotional decisions, from stock tips, and completely, please turn off CNBC. What you need to do is use discipline, have a rebalancing process, and maintain a diversified portfolio. Why? Well, none of us are really from Lake Wobegon. I don't know how many of you have ever listened to Garrison Keillor, but the closing words were always, well, that's the news from Lake Wobegon, where all the women are strong, all the men are good looking, and all the children are above average. Numerous studies show that we all think we're above average. People have been asked to rank their driving skills, and in the U.S., for example, 69%, actually in the U.S. it was 88% of the group said they had above average driving skills. Well, the nature of an average is only 50% can be above average. They've asked faculty at the University of Nebraska to rank themselves in their teaching ability. 68% rated themselves as above average. There's been all kinds of studies done that show that we have this natural tendency to be overconfident in our own abilities. And unfortunately, that works against us when it comes to investing. This is how we often invest. One of my favorite cartoons, and I'll read it in case you can't see it. The pilot has indicated we are going to experience a little turbulence. Please fasten your seatbelts. We're going to die. He's a financial reporter. This is why I tell you to turn off CNBC. Here's what the media does. This was the best 7 mutual funds for 1996. Well, how did those mutual funds perform? Well, over the subsequent year, the S&P was up 23%, the average U.S. stock fund up 19.5%, and Smart Money's best 7, 14.6. Here was Money Magazine in August 1997. Sell stock now. Now, this was right before 2 of the best years in the stock market. Here was 1999, right before tech stocks crashed. Everyone's getting rich. Tech stocks. Here's how to get your share. And here's Kiplinger's, a publication I have a lot of respect for and enjoy. And what I actually love about them is they have their Kiplinger's picks, and they themselves will publish the results each year. So this was 2006. Here were their picks. Domestic stock funds, their picks averaged 13%. Index funds, 15%. Kiplinger's picks in the international market, 22%. Index returns, 24%. What about star ratings? Well, this was the Contrarian Fund, which did phenomenal for many, many years. But Morningstar's own study came out, and this is in 2010, and said that their research has showed that using funds with low fees gives you even better returns than picking funds based on stars. So here's the secret to investing in retirement. You have to know your investment philosophy. You have to understand that we're all wired to look at the bright, shiny sports car. It drives by, it's flashy. That's the media. That's the people who are forecasting. Those are the people you often hear on the radio. They're often the people who have something to sell. Then you have your nice practical sedan. It's an economy car, but how's it going to hold up when the weather gets bad? What you really need in retirement is a Jeep, an all-terrain vehicle. You don't know what conditions you're going to encounter, and so you need something that it's not the least expensive. It may not be the most economical solution. It's not flashy, but let me tell you, when the roads get rough or the weather gets bad, it's going to get you to your destination. Retirement investing is just like the Jeep. It's not exciting. It's, unfortunately, it's really boring when you do it right. But it's very, very reliable if you build your portfolio correctly. Overall, your money is like soap. The more you handle it, the less you have. This was actually something I heard at a presentation years ago by Gene Fama Jr.'s son. Many of you probably don't know who Gene Fama is, but he is considered the father of modern portfolio theory. And it made me laugh. When you think about it, people who are active traders move their money around a lot. Research has shown they have less results to show for it. And that's really what the point he was making, is when you build the portfolio right from the beginning, when you build it with a purpose, once it's done, you shouldn't have to do a lot of moving around. You shouldn't have to watch CNBC. You shouldn't have to make trades every single day, nor even every week, and usually not even every month. So if you're not suited to do this yourself, where do you go? Well, what you need to watch out for are people that only have one tool. So all too often, I see people who call themselves a financial advisor, and they don't have to have any sort of credentials or degrees to use that term. And what they've got is a hammer to sell. Well, when all you've got are hammers, you're going to say that every single thing you see needs a hammer. In reality, you need to work with fee-only advisors, is what our belief is, or certainly independent advisors that have a plethora of tools that can look at your situation holistically and really tell you, here's the right way to construct that. And one of the things that we see is that a lot of people don't have the skill set to handle what's called the decumulation side. They may be great at constructing portfolios on the accumulation side, but when it comes to the expertise needed on the decumulation side, their knowledge base, they just may not be up to speed on how it works, on what sequence risk is, how taxes work, how Social Security works, all of those things. With that, we are going to open it up to questions. While we're going through questions, if anyone is interested in learning more about our services, you are welcome to send an email to us at info@sensiblemoney.com and just email the subject line PMQ. That stands for pre-meeting questions. All our services start with a complimentary conversation, and prior to that conversation, we ask that you fill out these online questionnaires. They're designed to be check the box. You don't have to type in a lot of things, so that it's pretty quick and easy. So with that, I am going to open it up to questions. Kathy's going to come back on, and then we'll have you type questions into the box. Kathy, are you there?
I am. Thank you. And yes, I see a couple people are already starting to type in your questions. And again, it's just where you typed in the word yes and some of your answers earlier this evening. Dana, I have a couple questions that came in before our webinar tonight that I'll start with. First one is, I am 6 to 8 years from retirement, and within that time frame will be downsizing from my current home. With 65% equity in my home, I am considering buying my next home with no debt and as to have no mortgage. This will also increase my cash flow by 20 to 30%, which is money that can be used for further investment or living expenses. Is this a reasonable idea, and what are the pros and cons?
Great question. So in general, having a mortgage in retirement, there's two ways to look at it. For lower income, lower net worth households, not having a mortgage is great. One, it reduces your exposure to what we call sequence risk. So we looked at what that is. So if you have to withdraw money from your portfolio every single month to cover your mortgage, you have a greater level of exposure to sequence risk. Whereas owning that home free and clear, you don't need that level of withdrawals. So I like having no mortgage for that reason. The other side of the coin, however, for high net worth households, and what do we mean by that? Generally people who have portfolio values of at least $1 million or more, maybe $2 million or more. In that case, debt can actually become a tool. Smart debt in particular can become a tool. And home equity loans, mortgages are one of the smartest types of debt you can own. So in that case, if you can get a low enough interest rate today, 15-year mortgage, maybe 3.25, 30-year, somewhere around 4.5, and your portfolio is expected to earn over time 6 to 7, then you're leveraging the difference. But there is more risk involved in that strategy. There's a great book on the high net worth, how to use debt side. It's called The Value of Debt, if people are interested in that. But in general, Center for Retirement Research has a whole study on this, and conclusively, if you can be in retirement without a mortgage, that's usually a good thing.
Great. Quick question was, will these slides be available? Yes, we will be sending out the slides to participants. Dana, can you please comment on bond funds as opposed to individual bonds?
Sure. So with a bond fund, you have a fund manager who's buying and selling bonds that fit a certain criteria. So it could be short-term bond funds, intermediate term, long-term. It can be the type of bond, municipal bonds, which generate income that's free from federal taxes, or you could have government bonds, or you might have treasuries, or you might have corporate bonds, you could have high-yield bonds. So you have to know the objective of the fund, but in general, when you own a mutual fund, when interest rates go up, you're going to see the price of those mutual fund shares go down because the underlying bonds in the portfolio on paper have gone down in value. Now, one of the challenges with it that a mutual fund manager has is when the share price goes down, if investors redeem shares, meaning people want to take withdrawals, the mutual fund manager has to sell holdings at that time. And so if interest rates go up, share price goes down, and investors say, I want out of this fund, and they start selling, a lot of them start selling, then the fund manager is forced to actually liquidate the bonds at exactly the time when they don't want to. They prefer to hold them to maturity. Sometimes they can't. And so there's some additional risk there in bond funds. Right now, if you're going to own bond funds, we prefer that you stay on the short-term side, bonds that have a fund that has what's called a low duration. So you want bonds that are going to mature generally in about 2 to 3 years, no longer than that. There's another option you can use. It's something called bullet shares. They're produced by Guggenheim. So if you Google the term bullet shares or Guggenheim bullet shares, you'll find a whole website around these. And they are a package of bonds that all have the same maturity date. So they can be a great solution. They kind of offer the best of a bond fund diversification and yet a known maturity date. They mature in December of each year where you have a pretty good idea of exactly what you'll get back.
Next question is, what are the major risk factors of an early retirement?
Ooh, great question. So healthcare costs, for sure. You can go to healthcare.gov and estimate what your premiums would be for insurance. Now, if you work for a company that's going to cover your health care, even if you take early retirement, you don't have to worry about that. But if that's you, you're very lucky. It's unusual today. So covering health care costs before you reach Medicare age is the first. 2, longer time horizon. So someone who's going to retire at 55 may have a potential 40-year time horizon versus someone who's retiring at 65. So that gives you more exposure to inflation risk, to sequence risk, to, what we actually call it is longevity risk. But you have 10 more years that you're going to need to take withdrawals. So that would be the other big factor to consider. And the third isn't really a risk, but it's really clarity of knowing what you want to do with your time. So I've been lucky enough to work with people who seem to love retirement, which is great, but every once in a while someone has a struggle with it. They were very invested in their career, and figuring out what they're going to do with their time and what their new passion is something that if you have an extra 10 years and they're your prime years, it's just something to consider.
Another comment. Please comment on the tax benefits of converting traditional IRAs to a Roth as opposed to keeping income low to take advantage of the ACA subsidies.
Okay. So just for all the rest of the listeners, the ACA subsidies, I believe that this participant is asking about, are the Affordable Care Act. So there's health care, there's tax credits that you can get if your income is low enough. It's hard to say. So the only way we can clearly come to an answer on that is to actually project out 2 different scenarios. One, where someone kept their income low and they were able to get the healthcare tax credits. And 2, a situation where someone converted IRA assets to a Roth IRA, which then shows up on your tax return as taxable income, so your income would be higher and you would not get the subsidies. It's impossible to know which is better without actually running 2 side-by-side scenarios and saying, all right, which one delivers the best result when looked at over a 20 or 30-year time horizon. On a side note, the advantage of the Roth IRAs, often there's a window of time. Let's say someone's going to retire at 60. They're going to delay the start of Social Security. There can be a window of time between 60 and 70 where you're in a really low tax bracket, and it can make a lot of sense to convert IRA assets to Roths, particularly if you don't have any other source of guaranteed income, if you don't have a pension or if your pension is low. And so later on, the Roth is so powerful, particularly if someone becomes a surviving spouse, their tax rates are going to go to single status instead of married, and the Roth is a perfect asset to use at that time. And so there's just a lot of, in addition, withdrawals from a Roth or IRA are not counted in the formula that determines how much tax you pay on your Social Security. So there's all these hidden advantages to a Roth that don't show up in a traditional online conversion calculator. So it's a great question, and I wish I had a nice, clear answer for you.
If I am in an asset liability matching strategy, and the fixed income bucket of bonds is only producing 2% interest, this won't even keep up with inflation. Is this correct?
Yes, that is correct. Well, actually, not necessarily. In the last few years, inflation has been really low, so that wouldn't have been a concern. And often, actually, you see a correlation with inflation and interest rates. So it's normal that as inflation goes up, interest rates are typically higher. But the way that we solve for that is we project out cash flows and we build inflation into the cash flows. So we assume somebody needs a little bit more income each and every year. And then it's both the interest income and the principal value of the bonds and CDs that you're using each year. So when you're looking at the portfolio as a whole, the portfolio as a whole is certainly designed to keep up with inflation. And so one of the mental biases we all do is something called mental accounting. We tend to put our money into little sleeves. This bucket's for this purpose, and this one's for this purpose, and so on. But really looking at all of your financial assets, home equity, Social Security, everything, it allows you to see the puzzle pieces in a different way and really look at how they can be used to come up with an overall objective. So technically, yes, the answer to your question is that portion of the portfolio is not keeping up with inflation. But if you're building the portfolio as a whole unit, the asset liability matching approach is designed definitely to keep up with inflation.
Next question, are there times when an actively managed mutual fund is a better decision than an index fund?
Oh, that's a wonderful question, very difficult to answer. Our view would be not really. The research is conclusive that, in large cap asset classes, for example, 80% of the time, index funds or passively managed funds beat the actively managed counterparts. So if I have research that shows that 80% of the time my client's going to have a better return by using an index fund, how could I in good faith use anything else? Now, when you get into some specialty asset classes, small cap stocks, or if you wanted a mergers and acquisitions fund or a sector fund, there can be some differences there. We don't build portfolios using those specialty funds, so that, when it comes to those asset classes, I really wouldn't have a clear answer. But as far as your broad, large cap, small cap, international, emerging markets, we would typically say index funds all the way.
Follow along with that one. Can you please comment on a dividend income strategy versus a low-fee ETF fund strategy?
Dividend income, it depends. You could buy, for example, your own stocks, or you could buy, their mutual funds or low-cost ETFs that only own dividend-paying stocks. It really is a matter of your level of sophistication. If you want to go out and pick the individual stocks, the mutual fund provides an easier kind of one-stop solution for that. So like a lot of things in life, I'll tell you, for me, I don't do my own taxes. I know a lot about taxes. I certainly could do my own taxes. Well worth the money for me to pay someone to do my taxes every year. Now, same, you have to decide, do I want to go out and pick individual stocks? Is that something I like to do? Do I like to do the research? Or do I want to own a mutual fund that just owns those dividend-paying stocks for me? I think it's just a trade-off. It's how do you want to spend your time?
That's a good question. What is your thought about recent research that has indicated that there may be an advantage to keeping the stock allocation low in the beginning of retirement and increasing it as retirement goes on?
So what that question is referring to is something in technical terms that's called a glide path. So there's what's called a rising equity glide path and a declining equity glide path. And so when you think about starting with, let's say you had $1 million portfolio, and we're going to put $500,000 in bonds, you're going to take out $100,000 a year, we would have 5 years worth of your withdrawals in safe investments. Let's say you're going to take out $50,000 a year. It's better. Now we have 10 years of withdrawals in safe investments. In a typical market scenario, the growth portion of your portfolio will grow fast enough that by the time you get to that end of 10 years, you will have bought more bonds, but you will also have just naturally a higher proportion of your portfolio in stocks. What that research shows is simply, actually it's based on using something like the asset liability matching approach, that if you match up your investments with the point in time that you need to use them, if the market's not doing well, you're spending your bonds, not just the interest income, but the principal too, and you're leaving the stock portfolio alone, and then it naturally will rise throughout retirement. So it's just a different way of describing really exactly what we've been talking about. We are fans of that research, so we like that concept of saying, I want to create a bond ladder and we're going to spend the interest and the principal when it matures. It gives you the flexibility to manage your stock portfolio based on what the markets are doing. If they're doing great, you take off the gains and you buy more bonds. And if they're not doing great, you simply use up some of the bonds that you've already bought. So the answer is, my thoughts are, I like that research, and it's exactly what our process is based on.
I have one more question, Dana. My retirement savings and my wife's are almost all in IRA accounts, with 80% of money invested in common stock of companies with good fundamentals, long dividend histories. I've always gone long, and for now I'm not uncomfortable with this approach. What is your opinion going forward?
Well, I don't know if you're retired or not. Was that part of the question, Kathy?
I believe this person is going to be is not retired yet.
Not retired.
They are about 6 years away from retirement.
6 years away. Okay. You're at the upper end of what I would be comfortable with as far as my stock allocation. A lot of it depends on your level of sophistication and how you react when the market goes down. If you're comfortable with that, I don't really see a problem with it. Ideally, you would start about 10 years away from retirement, and you would start actually buying bonds. So let's say I'm 10 years away from retirement, and I can buy a 10-year bond, which is going to pay a higher interest rate than a 1-year bond. So right now, you buy a 10-year bond, and it's going to mature the first year you're retired, and it's going to line up or match the amount you're going to need to withdraw that year. Then next year, you do the same thing. You sell some of your growth portfolio, you buy another 10-year bond, and then the next year, the same thing. If you did that every year, starting 10 years away from retirement, by the time you get to retirement, you're going to have the next 10 years of your withdrawals 100% secured by safe investments. That's the process that we like to use, and you are at a perfect time to start doing that. You could start with the 20% of your portfolio that's in bonds, but every year I'd be wanting to pare down the stock portion, and I'd probably want to get it down to at least 70% by the time I was at retirement.
All right. I think that is it.
Fantastic. Well, thank you, everybody, for joining us tonight. I really appreciate you taking the time. We will get the slides out in the next few days, and assuming the recording has good sound quality, it takes us usually a week or two, but we typically get that posted to YouTube, and we will send that all out also. Have a great night, and happy 4th, everybody.
Bye-bye.